Candlestick patterns are a crucial part of trading, yet most traders neglect them completely. They don't realize these must-know candlestick patterns not only complement all of your knowledge about market structure, volume, heat maps, and raw data, but they allow for better predictions and more precise trading. Basically, if you don't know candlestick patterns, then you're trading with some major blind spots and leaving too much up to guesswork. And, let's face it, this means you're leaving money on the table, if not losing some in the process. The good news? These don't have to be complicated. In this video, I'm going to break down what candlesticks are, how they affect your trade, and ultimately 5 candlestick patterns that can save you from losing money. Be sure to stick around to the end because I'm going to share my favorite candlestick pattern that has given me some of my best results. Now, let's get started by demystifying what candlesticks are. A candlestick is the simplest way of seeing an asset's price movement during a specific time period. If you're looking at a daily chart, each candle represents one day's price movement. If you're on an hourly chart, then each candle shows 1 hour of price action. Now, a candlestick has 3 basic features. First, the body. This middle section right here is the body. It can be short, medium, or long, depending on how much the price moved. The body shows you the opening and closing price of an asset during that time period. Then comes the wicks. These thin lines you see above and below the body are called wicks, or sometimes shadows. The end of the upper wick shows the highest price reached during that period. Similarly, the end of the lower wick shows you the lowest price hit during that same time. Then we have the most important aspect, the color. On a chart, you'll see candles in 2 colors, green and red. When buyers dominate and push the price up, the body appears green. This is called a bullish movement, symbolized like a bull thrusting its horns upward. On a green candle, the bottom of the body is the opening price, while the top is the closing price. Similarly, a candle appears red when sellers take control and drive the price down. A red candle is called bearish, considering how a bear swipes downward with its paws. On a red candle, the top is the opening price, while the bottom is the closing price. Understanding candlestick patterns is like learning traffic signals. Once you've understood them completely, you can't go wrong with your trade. Now, not all candlesticks are as simple as they seem. They range from basic to advanced, starting with single stick patterns and progressing to multiple stick patterns at a more advanced level. So let's start with the basics. Single stick patterns. These are the simplest yet most powerful signals because one candle alone can reveal a lot about market sentiment. Single stick patterns usually show rejection or indecision, hinting that a potential reversal might be near. The best single stick candle is a doji candle. A doji candle has a thin body with equal wicks above and below it. In Japanese, the word doji means the same thing, which kind of explains what this pattern represents. You see, the open and close price points are almost at the same level, which shows an indecision between buyers and sellers. The sellers tried to push the price down while buyers tried to bump it up. And at the end, the price closed at almost the same point where it first opened. You need to understand that a doji by itself doesn't show a directional bias. However, when you see multiple dojis forming in a row, it signals that the market is going to take a wild move in either direction, whether upward or downward. For example, if you notice a doji with a small body near the top and a long wick extending below it, that's called a dragonfly doji. This pattern generally indicates that prices might fly upward, just like a dragonfly taking off. On the other hand, if you see a doji with a small body near the bottom and a long wick extending upward, that's a gravestone doji. Whenever you see a gravestone doji, just know the prices will be so down, they'll be laid to rest under it. Pro tip: if you spot a dragonfly doji and the next candle closes green above its high, you can enter a buy position with your stop loss set just below the lower wick. Similarly, for gravestone, you can enter a sell position with your stop loss set just above the upper wick. Now that you understand doji, let's move on to another single stick pattern you'll often see on charts called the pin bar. A pin bar is a candlestick that has a large wick on one side and a small body on the other. Typically, we have 2 main types of pin bars. A bullish pin bar is a green candle with a longer lower wick. A bearish one is when the candle is red with a longer upper wick. But before you focus too much on the color, understand this. The color of the candlestick is not quite important. However, bullish candles with a green real body are more powerful than candles with a red body. On the other hand, bearish pin bars with red real bodies are more important than the ones with green bodies. Whenever you see pin bar candles on the chart, it means that sellers were initially dominating, pushing the price down, but then buyers came in, rejected those lower prices, and managed to bring the price back up before the candle closed. So basically, the pin bar pattern shows market rejection and indicates a potential reversal. Now, let's move to the medium hard level, the double stick patterns. These patterns are formed by two consecutive candles and show a clearer shift in control between buyers and sellers. The most crucial double stick pattern is engulfing candlestick. Engulfing candlestick is a double stick pattern where the first candle has a smaller body, which is totally overpowered or engulfed by a larger candle of the opposite color. The key point is that the second candle should have a larger body on both ends. To be considered a true engulfing pattern, the larger bar should at least cover one previous smaller candle. However, it can cover multiple smaller bars at the same time. Now, this pattern can be of two types, bullish and bearish. A bullish engulfing pattern forms when a smaller red candle is totally covered by a larger green candle. So what does this pattern actually convey? See, during the red candle, the sellers were in control and pushed the price down. Seeing this downward trend, the next candle then opened at an even lower price, showing that sellers are still trying to control the market. But suddenly the buyers came in, started aggressive buying, and pushed the price up to the point it crossed the highest point of the previous red candle. The green candle becomes so big that it engulfs the entire red candle, which shows us that the buyers have now taken complete control from the sellers. When you see this pattern forming at the bottom of a downtrend, where the price has been continuously falling, it's a strong signal that the market might reverse. Also, the bigger the green candle, the stronger the bullish engulfing trend, which is a strong buying signal. But the smarter move would be to confirm if you notice the pattern with the next candle or a key support bounce before entering. The same applies to bearish engulfing patterns. When a bearish engulfing pattern forms, it could signal a possible downward reversal, as the large red candle indicates that sellers have gained strength over buyers. If you spot a bearish engulfing pattern, you can enter a sell position once the red candle finishes forming. Till now, we have covered the basic single stick and double stick patterns. It's time to move on to an advanced level, which involves observing 3 or more candles at once in multiple stick patterns. Decoding multiple stick patterns demands more technical knowledge and expertise, but these are my favorite because they give stronger confirmation since they show a more developed battle between buyers and sellers. The morning star is a powerful 3-candle reversal pattern that signals the short-term end of a downtrend. Just like the morning star appears before sunrise and signals a new day, this pattern appears at the bottom of a downtrend and signals a potential bullish reversal. The morning star is formed by 3 candles. The first one is a medium-length bearish candle, showing that sellers are in full control and pushing the price down aggressively. The second candle opens down with a gap. It's a small bullish or bearish doji, showing tension between buyers and sellers. The third candle is where things get interesting. It's a large green candle opening with a gap up. It starts near the low of the first red candle and closes near the high of it, signaling a potential reversal. The psychology behind this pattern is simple. See, during the first candle, sellers dominated completely. They pushed the price as low as they could. Then, as the second candle formed, the momentum slowed down. Neither buyers nor sellers had full control. Finally, when the third candle opened, buyers came in aggressively, overwhelming the sellers and pushing the price significantly higher. This shift from bearish dominance to bullish control makes the morning star a reliable reversal signal. Whenever you spot this pattern at the bottom of a downtrend, it tells you that selling pressure has exhausted and buyers are ready to take the price higher. Now let's look at the evening star. As the name suggests, the evening star appears at dusk and signals the end of daylight. This pattern appears at the top of an uptrend and signals a potential bearish reversal, which means it's the complete opposite of a morning star. The first candle is a large green bullish candle. The second is a small doji, and it can be either green or red. The last one is a large red bearish candle that closes well into the body of the first green candle. It works the exact opposite of a morning star. So during the first candle, buyers pushed the price to maximum highs. Then, as the second candle appeared, sellers tried to balance it, which is shown by a doji. And finally, at the third candle, sellers dominated the buyers and pushed the price significantly lower, resulting in a shift from an uptrend to a downtrend. And there you have it. Now, you can start memorizing these from basic patterns like doji to to multi-stick patterns like the evening star, so you can spot them at a glance. You can also identify these in different views based on your trading platform to help you along the way. Thanks for tuning in, and we'll see you in the next video.